Well, 2023 wasn't a great year for the emerging markets because there were a lot more outflows than inflows into the emerging markets, and it was the developed market that was taking a lot more share of the flows. But the big question is, will 2024 be different? And how is India placed if the money does come back to emerging markets? These are the questions that we'll pose to Hiren Dasani. He's, of course, the co-head of emerging markets equity and the lead portfolio manager at Goldman Sachs Asset Management, joining us on the show. Hi, Hiren. Good to be speaking with you.
Thank you, and good to be here today.
Well, that's exactly my first question, Hiren, to you. 2024, how different is it going to be versus 2023 for emerging markets, especially with respect to flows?
So let's look at how 23 panned out. The start of the year 2023 was very different. There was a lot of optimism about reopening of China from COVID and the consumption recovery and the economic growth picking up there. And China market did perform quite very well in the first quarter of 2023. It is in the second half of 23 where we started to get much more positive in terms of the India market because the inflation trajectory was slowing down in India. The crude oil prices were kind of stabilizing, and the economic growth was quite great. So if you look at the market performance, it was significantly positive in the second half of 2023, and obviously flows also started to pick up in India towards the second half of 2023 from the foreigners. Now, I firmly believe that over time it is the economic fundamentals which drive the flows and not the other way around. Flows will come if the fundamentals are good. Flows will go out if the fundamentals are not that great. So I think the economic growth trajectory improving, very stable macro situation in terms of currency and the interest rates which India has demonstrated, I think those are the ones, those are the fundamentals which are attracting the flows to India increasingly in the last few months.
But Hiren, fundamentals at a price, right? When you look at the valuations in India, it's not cheap. We are still trading almost 19 to 20 times the forward earnings, which has been a little higher than the historical averages. Is valuation something which is worrying the investors when it comes to India, or given the growth prospects, they're willing to buy growth at that price?
Yeah, this is a very interesting question, and we always tell clients that India valuations need to be looked at in the context of few things. One, India is a stronger for longer market. So our starting point of the corporate earnings is, our starting point of the economic growth is that we are starting from about $2,500 per capita income. And there is a visibility of medium to long term double-digit corporate earnings growth for a long period of time. Now, there are very few markets in the world today where you can see the double-digit earnings growth visibility over the next 10 years, not only for 1 or 2 years. So that is the first thing. Valuations are a function of what is the extent of growth and what is the duration of growth. And India obviously, takes very favorably on both of that. The second part, how the valuations are, driven by, is the cost of capital, right? And the cost of capital is a function of the interest rates, which in turn is a function of the inflation. So one great thing which has happened in India over the last several years is the stability of inflation. And we have seen that inflation is now much lower. In fact, we did not have as a country formal inflation targeting approach before few years, and we have seen that inflation has remained much stable in the last few years. So if the inflation were to be moderate, it would lead to moderate interest rates, and it would have its implications on the cost of capital and in turn higher P multiple. So we have seen that India has historically traded at a premium to its peers in the emerging market, and that premium is usually justified because of stronger for longer type of growth, and that premium is also justified because of the lower volatility of India's corporate earnings. I think this is one aspect which is less appreciated. If you look at India's corporate earnings, they have not declined for more than 2 years in the past 30-year history. The only time when the corporate earnings declined was during the financial crisis or during the taper tantrum period. But unlike many other Asian markets where earnings can be quite volatile on a year-on-year basis, India has much more stable secular type of earnings growth because of the composition of India's corporate sector. And the third element about the valuations is also about the private sector versus public sector. I mean, obviously India is much more dominated by the private sector companies, which tend to have somewhat higher multiple compared to the state-owned companies historically. So if you adjust for all these factors, I mean, India's valuations have always traded at a premium to the emerging market, and it continues to trade at a premium. Now, if you look at India's own history, the last 10-year average multiples of Indian market would be at about 18 times 1-year forward multiple. Currently, we are talking at about 20 times 1-year forward multiple. So compared to last 10-year average multiples, yes, markets are a little bit more expensive, but it's not that it's hugely expensive. One also needs to understand that the visibility of the mid to high teens corporate earnings growth is also there today, which was not there for a long period of time earlier. So if you put all those things together, India's valuations, yes, they are expensive, but they are expensive for the reason and they are justifiable.
Sure, point taken that the valuations are justifiable given the corporate earnings that we have seen. But the question is, Hiren, the flows which are likely to come to India or which are coming to India in the last couple of months, are they more from the basket buying of emerging markets, or there are dedicated Indian flows as well that you are seeing? And if yes, is it more tilted towards, let's say, large caps or a specific sector, or is it very broad based?
Yeah, so that's an interesting question. I mean, we should not broad brush the foreign flows in one bucket, because within the FPIs there are various types of investors. There are sovereign wealth funds, there are endowment funds, there are pension funds, there are individuals who are putting money through the private banks and through the wealth advisors, etc. So it's a variety of flows which all get clubbed as the FPI when we look at the aggregate number. And in terms of the mandates also, there are various types of mandates, like there are India dedicated mandates, there are emerging market funds, there are global funds for which India may be a very small part of their benchmark. And each investor will have a different risk appetite, each type of fund will have different mandate. So broadly speaking, if you look at the allocation of the global funds or the emerging market funds where the India is about 16-17% of the benchmark, they are overweight on India today, but they are very moderately overweight on India. In 2014-2015, when Prime Minister Modi came to the power for the first term, around that time the overweight of the global emerging market funds into India was as high as about 5% plus. Today that overweight is about 1% or so. So you can argue that there is some scope of that overweight going up if you look at the historical high numbers. The second point I would make about the India dedicated funds, till about 2023, India dedicated funds were not receiving significant inflows. It's only in the second half of 2023 where India dedicated funds have started to get a significant amount of inflows, as many investors globally who are the global asset allocators are now thinking of standalone India allocation, which was not the case for many global pension funds and the other asset allocators earlier. So as India becomes more relevant, the dedicated India flows will become more relevant as well. And the kind of stocks, if you purchase from a global emerging market or a global fund, where you may have only 10 to 15 stocks in India, would be very different compared to India dedicated fund, which would have many more number of stocks in India. So it has its implications that if more India dedicated mandates, if more India dedicated funds get the incremental flows, you might see broadening out of that investments into mid and small cap as well as the large cap. But if the flows get driven by only the global funds where India is part of that allocation, then those flows tend to be concentrated more towards the larger cap companies.
That's interesting. So, of course, you can't paint it with the same brush, need to look at it in finer details. But since you brought that topic of the political stability in the country, how big a risk or how big an event is the election which is there towards the mid of the year? And is there a lot of confidence in foreign investors when it comes to the policy stability and the kind of impetus that the government has given, whether it is in case of manufacturing, whether it is case in terms of the other verticals as well?
Yeah, I mean, obviously nobody likes uncertainty as an investor. So stability and continuity of the economic policy is quite well regarded, and it's quite quite in demand always. It's not only in India. In any markets of the world, you would want less uncertainty on the political front and more continuity on the economic policy. I mean, I'm not a political expert. I'm not going to predict the outcomes of the elections, but it is quite a consensus today about the continuity of the political regime and continuity of the economic policies. So, which is enthusing the investors to make more longer term, more medium term asset allocations calls for India. Having said that, one also needs to acknowledge that historically, India and Indian markets have grown under different political dispensations as well. So it's not that the direction of the economic policy is very different. It's the execution of the economic policies where obviously the single party majority in the parliament makes a lot of difference, and that is what we are seeing in the last few years. Where the execution of many of the economic policies has been quite strong. So yes, political stability and policy continuity is important, but I would also make a point that historically the direction of the economic policy has been fairly consistent in India under different political regimes.
That's an interesting point to mention, but I also wanted to glean into your insights as to, is there a specific sector or a theme that the investors are liking at this point of time? I ask you because, of course, in terms of the financial sector, that's always been a preferred sector. There's the entire favorable demographics which makes consumption very attractive. We have been talking about the K-shaped recovery and the comeback of the luxury space in India as well. Is there a specific sector or themes that investors are talking a lot more about?
Yeah, I mean, historically we have found much more alpha generation opportunities in sectors like financials, consumer, information technology, industrials. Those are the sectors where on a bottom-up basis we find a lot more attractive opportunities. And it continues to be the case that financials, consumer, information technology, healthcare also I would put there, industrials. Those are the sectors where there are quite a few interesting bottom-up companies to pick and choose from. The good thing about India is that it's a stock pickers market. Close to $4 trillion market cap now. More than 500 companies or close to 500 companies with more than $1 billion market cap, more than 1,000 companies with more than $200 million market cap. So it's a stock picker's delight. I mean, you can pick and you can find and pick stocks, great businesses across multiple sectors. Obviously, consumption and services have been the historical drivers of growth in India. Going forward, it is expected that manufacturing will also be the additional driver of growth for India. So we don't think consumption in services will become less relevant. Obviously, manufacturing, where India was not so competitive earlier, is where it's the additional incremental driver of growth is what we are seeing as investors. So we like bottom-up stock picking approach across multiple sectors, but we do find more opportunities in financials, consumer, information technology, industrials, and healthcare.
Okay, Hiren, on that note, we'll let you go. Interesting take there. That is the bottom-up approach and the stock-specific, stock pickers market right now. And of course, the Indian premium is well justified because the corporate earnings have been very strong. Thanks so much for making time and speaking with us.